The One Big Beautiful Bill Act was signed into law July 4th, 2025. It brought forth a new senior tax deduction, and here's what every senior needs to know. The One Big Beautiful Bill Act, signed into law July 4th, 2025, includes one of the most meaningful tax updates for older adults in decades. Today we'll break down the new senior deduction, how it works, who qualifies, and how smart planning can save you thousands. Because this is something every senior needs to understand, and at Uhart Tax Financial, we're here to help you and your family navigate this with confidence and clarity. And remember, be sure to like and subscribe so you don't miss any of the tax tips and words of wisdom to help you achieve financial success. Now let's get started. The senior deduction, effective 2025 tax year, is $6,000 for single filers and $12,000 for married filing joint. Here's a three-part benefit that you need to understand. Everyone gets a standard deduction. $15,570 if you're single, $31,500 if you're married filing joint. There's a senior bonus, which is age-based. If you're over 65 or blind, you get an extra $2,000 if you're single and an extra $1,600 per spouse if you're married. That was the normal standard deduction. Now, on top of that, you'll get the new senior deduction, thanks to the OBBBA, of an additional $6,000 or $12,000. Let's look deeper into how this works. If you're single, you'll get the following deductions: $15,750 for standard, plus $2,000 age, plus your $6,000 senior. That's $23,750 in a total standard deduction. Now, if you're married and both of you are over 65, you'll get $31,500 as your standard, $3,200 for your age bonus, and $12,000 for your senior bonus. That's $46,700 of a total standard deduction. This reduces your income before you're even taxed. There are a few critical points. If you're married, you must file jointly, because if you file separate, you'll get zero. There's also income limitations. But let's take a deeper look at how this deduction looks. So you get your basic standard, $15,750 if you're single, plus your $2,000, plus your $6,000. Again, that's a total of $23,750. So let's assume you're 67 years old and you made $70,000. So instead of being taxed on the $70,000, you're only taxed on $46,250, and you're in a 12% bracket. Let's compare this to the old rules. Under the old TCJA, you likely would have been in a higher tax bracket. So before this new law went into place, you'd only get $15,000 standard deduction plus your $2,000 age bonus. That's only $17,000. Subtract that from your $70,000 income, your taxable income would have been $53,000. Under the new rules, it's $46,250. So that extra $6,000 brings you out of a 22% bracket. It can save you hundreds and thousands of dollars under this new law. And by reducing your taxable income, you avoid crossing into that 22% tax bracket, keeping yourself in the 12%, reducing your taxes by about $424 just by that lower range. But here's why strategic planning is so important, especially as the year goes on. Let's say you earn a little bit more, maybe $73,000. You still qualify for the senior deduction, but you're now closer to the $75,000 phase out, because once you go over $75,000 if you're single, or $150,000 if you're married, your senior deduction starts phasing out. That phase out happens relatively quickly, a 6% phase out. So even being a few $100s over could cost you lost deductions. But have I got a tip? We could adjust your income potentially. There are things during the year that you do financially that could impact your tax return, such as interest and dividends, capital gains, or IRA distributions. Let's say you're taking $25,000 a year from your IRA, but your required minimum distribution is really only $10,000. And maybe you don't really need that extra income. You were just told, take out $25,000. Looking at it again, that extra $15,000 It could be pushing you into a higher tax bracket or costing you part of your senior deduction. So consider this. Do you really need that full $25,000? Could you reduce your withdrawal by $5,000 and stay under the deduction threshold? That $5,000 could also potentially stay invested, earning more money for your future while lowering your tax bill today. That's tax smart living. But on the flip side, maybe you're not taking enough, or your budget feels a little tight every month. Potentially you could take out an extra $5,000 now and still stay in the lower tax bracket. That money could potentially give you the breathing room you need, or be moved into a non-IRA vehicle such as an individual account, a transfer on death, or a trust account. It keeps growing, it's more flexible, and could be less taxable by your loved ones later. Remember, inherited IRAs must be withdrawn within 10 years and are taxable to your heirs and beneficiaries. Planning now could not only save you money, but it can save them money too. An important warning I wanted to give on this as well is you have to have a Social Security number to claim the senior deduction. One issue that's come up is if your Social Security number is entered incorrectly on a submitted tax return, the IRS may disallow it. So be sure to check your Social Security number before submission. Usually tax pros, when they file your tax return electronically for you, it often rejects if the Social Security is mismatched. But it's still always important to double check your information in your tax return that you are signing. So absolutely this new deduction is meaningful to seniors, and it even starts to fulfill the 2024 campaign promise by President Trump to reduce the taxation of Social Security benefits. While it doesn't eliminate those taxes altogether, this higher deduction does help you keep more of your retirement income untaxed. But the bottom line, this kind of benefit only works when you plan ahead. By planning with a tax professional that knows your situation and your income, needs, and benefits, we can plan to keep your taxes reduced, keep the most amount of money in your pocket, and ensure that you have the financial means to live a happy and fulfilling life. Thanks for joining us today. This presentation, as always, is educational purposes. It's not a guarantee of outcomes or providing any specific tax advice. It is recommended if you reach out to a professional licensed tax advisor for your own specific returns. Now go enjoy your day and achieve financial success.